In 2008, banks failed and governments bailed them out. You know that part. What they didn't tell you is what they quietly legislated in the years that followed. A new legal framework, a new set of rules governing what happens the next time a major bank approaches the edge of collapse. They promised no more taxpayer bailouts. They kept that promise. But they did not fix the banks. They did not reduce the leverage. They did not eliminate the risk. They simply changed who takes the loss. And the answer to that question, who takes the loss? When a bank fails under the new rules, is the most consequential piece of financial information that the majority of depositors in the developed world have never been told. It is you, not through a tax, not through inflation, not through any mechanism that requires political authorization or public debate, through a legal process called a bail-in, a process in which a failing bank is authorized to take depositor funds, your funds, and convert them into bank equity to recapitalize itself. Your savings, converted into shares of a failing bank without your consent, within a legal framework that has been adopted by the G20, codified into law in the United States, the United Kingdom, and across the European Union, and tested in a real banking crisis in 2013. This is not a theory, it is policy. Written down, signed into law, waiting. Part 1. The legal illusion. You are not the owner. Before we can understand bail-ins, we need to establish a legal reality that most people find genuinely difficult to accept the first time they encounter it. The money in your bank account does not belong to you, not in the legal sense that matters when things go wrong. When you deposit money into a commercial bank, you're not placing your property in storage. You're not maintaining ownership of specific funds held in trust on your behalf. You're making a loan. You're lending your money to the bank. The bank takes legal ownership of the funds. You receive in exchange a contractual promise, an IOU, that the bank will return an equivalent amount when you request it. This is not a technicality buried in the fine print of an obscure legal document. It is the foundational legal structure of commercial banking, established through centuries of common law and confirmed repeatedly in court rulings across multiple jurisdictions. In the 1848 English case of Foley versus Hill, the House of Lords ruled explicitly that money deposited with a banker becomes the banker's money, to do with as the banker pleases. The depositor, in exchange, receives a debt, a legal claim against the bank for repayment. You are not a customer storing property. You are an unsecured creditor who has lent money to a highly leveraged financial institution. The word unsecured is important. In any insolvency proceeding, creditors are ranked. Secured creditors, those whose claims are backed by specific collateral, are paid first. Unsecured creditors receive whatever remains after secured claims are satisfied. In a significant bank failure, that remainder is often a fraction of the original claim, paid out over years of bankruptcy proceedings. You are at the back of a very long line. In normal times, this legal reality is invisible. Banks function, deposits are accessible, the IOU is honored. The distinction between owning money and holding a claim against a bank that owns your money is academic. In a crisis, it is everything, because the legal framework that governs what happens to your deposit when the bank that owns it cannot honor its obligations is not the framework most depositors imagine. It is not a framework designed primarily to return depositor funds. It is a framework designed to manage the failure of systemically important financial institutions in ways that protect the broader financial system. And under the new bail-in framework, managing that failure now includes the legal authority to use depositor funds as the raw material of bank recapitalization. Part 2. The end of the bailout. How they changed the rules. In September 2008, Lehman Brothers collapsed. Within days, the global financial system was approaching a complete seizure. Credit markets froze, interbank lending stopped. The machinery of global commerce ground toward a halt. Governments responded with interventions of unprecedented scale. The United States Treasury committed hundreds of billions of dollars to stabilize major financial institutions. The Federal Reserve expanded its balance sheet dramatically, providing liquidity to markets and institutions that would otherwise have failed. Similar interventions occurred across Europe and the United Kingdom. The public reaction was one of sustained and genuine outrage. Banks had taken risks that produced enormous profits in the years preceding the crisis. When those risks materialized as catastrophic losses, governments used public funds, taxpayer money, to prevent the consequences from falling on the institutions that had taken the risks. The people who had made the decisions that caused the crisis were largely insulated from its worst effects. The public, which had made no such decisions, paid the bill. The political pressure to prevent a repetition of this outcome was intense and bipartisan. The promise made repeatedly and publicly by legislators and regulators in the years following 2008 was clear. There would be no more taxpayer bailouts of failing banks. This promise was kept. But the way it was kept requires careful examination. The solution that regulators and financial policymakers developed was not to reduce the systemic risk that made bailouts necessary in the first place. Banks were not broken up. Leverage ratios were not reduced to levels that would make bank failures manageable without extraordinary intervention. The fundamental structure that had made certain financial institutions too big to fail remained substantially intact. What changed was the mechanism for managing failure when it occurred. Instead of using public funds to recapitalize failing banks, the bailout model, regulators developed a framework for using the bank's own liabilities to recapitalize it. In a bail-in, when a bank's losses exceed its capital buffers, certain liabilities are written down or converted into equity. The bank's creditors, including, under certain frameworks, its depositors, absorb losses rather than the public treasury. The promise was technically honored. Taxpayers would not fund the next bank rescue. The identity of who would fund it simply changed. The transition from bailout to bail-in was not a minor regulatory adjustment. It was a fundamental restructuring of the legal relationship between banks, their depositors, and the state. And it was accomplished largely outside the public debate that might have been expected to accompany a change of this magnitude. The Dodd-Frank Act, passed in the United States in 2010, established the Orderly Liquidation Authority, a legal framework giving the FDIC the power to resolve failing financial institutions through processes that include bail-in mechanisms. The Bank Recovery and Resolution Directive, adopted across the European Union in 2014, established similar frameworks with explicit bail-in provisions applicable to deposits above insured thresholds. The United Kingdom adopted comparable legislation. The G20, meeting in Brisbane in 2014, endorsed a framework developed by the Financial Stability Board, establishing minimum requirements for the loss-absorbing capacity of globally, systemically important banks. Requirements designed explicitly to ensure that sufficient liabilities exist to be bailed in when needed. These were not secret documents. They were published. They were publicly available. They were reported on in financial press. They were not explained to depositors. Part 3. The Cyprus Rehearsal. The Proof. In March 2013, the island nation of Cyprus became the first developed country to implement a bail-in of depositor funds in the modern era. Cyprus had developed a banking sector dramatically disproportionate to the size of its economy. Its banks had accumulated assets equivalent to approximately 8 times the country's annual GDP, much of it from foreign depositors attracted by the island's tax structure and banking confidentiality. A significant portion of those assets had been invested in Greek government bonds. When Greece's debt crisis forced a restructuring of its government bonds in 2012, Cypriot banks suffered losses that effectively wiped out their capital. The country's banking system was insolvent. Cyprus required a bailout from the European Union and the International Monetary Fund. The terms of that bailout included a condition that the Cypriot banking system itself contribute to the recapitalization, meaning that some of the losses would fall on bank creditors rather than entirely on European taxpayers. On the morning of March 16, 2013, Cypriot citizens and depositors around the world woke up to news that would have seemed unthinkable days earlier. Bank accounts in Cyprus were frozen, withdrawals were restricted, and the terms being negotiated between the Cypriot government and its international creditors included the direct confiscation of a percentage of bank deposits above a specified threshold. The initial proposal called for a levy on all deposits, including those below the insured limit of €100,000, a provision that was subsequently modified after significant political pressure. The final terms that were implemented imposed losses on deposits above €100,000 at the 2 largest Cypriot banks. Depositors at Laiki Bank, the country's second largest financial institution, faced losses of up to 80% on deposits above the insured threshold. At the Bank of Cyprus, deposits above €100,000 were converted into bank shares, equity in an institution that had just experienced catastrophic losses. People who had placed money in a bank account, not in speculative investments, not in high-yield instruments carrying disclosed risk, but in a standard bank deposit, lost a substantial portion of their savings, not because of decisions they had made, but because of decisions made by the bank that legally owned their money. The Cyprus bail-in was not an accident. It was not an anomaly. It was the application for the first time in the modern era of a framework that had been in development for years in response to the 2008 financial crisis. European officials at the time described it as a template, a model for how future banking crises in the European Union would be managed. The word template is worth sitting with. A template is not a one-time emergency measure. It is a reusable pattern, a framework designed to be applied repeatedly in different contexts, whenever the conditions that trigger its use arise. Cyprus was the proof of concept, the demonstration that bail-ins, in practice, worked as a mechanism for managing bank failure, that depositors would absorb losses, that the financial system would survive the shock, that the template was viable. Part 4. The G20 Master Plan Official Policy. The bail-in framework is not a contingency plan gathering dust in regulatory archives waiting for a crisis that may never come. It is active policy, continuously refined, with specific legal mechanisms in place across the major developed economies. In the United States, the Dodd-Frank Act's Orderly Liquidation Authority provides the legal basis for FDIC-managed resolutions of failing systemically important financial institutions. The framework includes provisions for imposing losses on creditors, including unsecured depositors above the FDIC insurance limit of $250,000 as part of the resolution process. In the European Union, the Bank Recovery and Resolution Directive establishes a clear hierarchy of bail-in. When a bank's capital is insufficient to cover its losses, shareholders are wiped out first, then holders of certain hybrid instruments, then subordinated bondholders, then, if those buffers are insufficient, senior unsecured creditors, a category that includes deposits above the insured threshold of €100,000. The United Kingdom's Banking Act and subsequent legislation establishes comparable frameworks. The Financial Stability Board's Total Loss-Absorbing Capacity Standard, endorsed by the G20, requires globally systemically important banks to maintain sufficient loss-absorbing capacity to ensure that bail-ins can occur without threatening systemic stability. These are not hidden laws. They are published, accessible, and routinely discussed in financial regulatory circles. What they are not is routinely explained to the depositors they most directly affect. The FDIC insurance that most Americans rely on as their primary understanding of deposit protection covers up to $250,000 per depositor per institution. For the vast majority of individual depositors, this coverage is sufficient to protect their entire bank balance. But for businesses, for individuals with savings above the threshold, for anyone whose relationship with a bank involves balances that exceed the insured limit, the bail-in framework creates a direct and legally established exposure that most of them are entirely unaware of. And FDIC insurance itself operates on the assumption that bank failures will be isolated events rather than systemic crises affecting multiple large institutions simultaneously. The FDIC fund, while substantial, is not sized to handle the simultaneous failure of multiple globally systemically important banks. In a scenario where bail-in frameworks are actually triggered, the systemic conditions producing those failures would likely be precisely the conditions under which the insured depositor's confidence in the FDIC backstop would be most tested. The framework answers the question of who pays when the system fractures. It answers it clearly, in legal language, in published documents adopted by the governments of the world's major economies. It simply does not advertise the answer to the people most affected by it. The climax, the system designed to consume its depositors. The arc of this story runs from 1848 to the present. In 1848, English courts confirmed that deposited money belongs to the bank. The depositor is a creditor. In 2008, the consequences of banking risk were absorbed by public treasuries because the alternative, allowing the financial system to collapse, was politically and economically unacceptable. In the years following 2008, governments promised no more taxpayer bailouts and built legal frameworks to honor that promise. They moved the loss from the public treasury to the bank's own creditors. They created the legal architecture for bail-ins. In 2013, Cyprus demonstrated that the architecture worked. Depositors absorbed losses. The system survived. The template was validated. Since 2013, that template has been codified into law across the major developed economies, endorsed by the G20, and continuously refined by the Financial Stability Board. The depositor, in this arc, moves from the presumed beneficiary of a banking system designed to hold money safely, to the legal owner of a claim against an institution that can use that claim as raw material for its own recapitalization in a crisis. The system was not designed maliciously to harm depositors. It was designed by regulators seeking to manage the genuine and serious problem of systemically important bank failures without imposing the cost entirely on the public. There are legitimate arguments for bail-in frameworks. There are real risks in a world where only taxpayer bailouts are available, but the framework was designed, refined, and implemented without a serious public conversation about what it means for the people whose savings fund it. Without clear communication to depositors that their relationship with their bank is legally the relationship of an unsecured creditor, not an owner. Without honest disclosure that, above the insured threshold, their deposits are part of the loss-absorbing capacity of the financial system. The system is designed to consume its depositors when it fractures, not as a goal, as a mechanism. You were not told this when you opened your account. You were not told this when you exceeded the insured threshold. You were not told this when the legislative frameworks that govern this outcome were adopted. You are being told now. The 2008 financial crisis produced public outrage at the spectacle of private losses becoming public liabilities. That outrage was legitimate. The bailouts were a genuine transfer of risk from the institutions that created it to the public that didn't. The bail-in framework that replaced it is, in important respects, an improvement. It eliminates the most direct form of taxpayer subsidy for institutional risk-taking. But it creates a different problem. It places the burden of bank recapitalization on depositors, who almost certainly do not know they're carrying it, who opened bank accounts believing they were storing their money safely, who exceeded insured thresholds in the ordinary course of managing their financial lives without understanding the legal exposure that excess creates. The next major banking crisis will test these frameworks in ways that Cyprus, a small island economy, did not fully reveal. When it does, the legal architecture is in place. The hierarchy is established. The process is designed. The question is whether you understand your position in that hierarchy before the process begins. Now you do. If this gave you a new perspective, subscribe to Economic Chronicles, the hidden architecture of money and power. We show you where to look.